For most of us, life follows a predictable schedule. You spend your first 2 decades in a classroom, the next 4 decades at a job, and if everything goes according to plan, you get about 15 years at the very end to finally relax. To make sure you can afford those final years of rest, standard financial advice tells you to set aside roughly 10 to 20% of your paycheck throughout your entire working life. But this deeply ingrained system comes with a significant catch. It requires you to hand over your healthiest, most energetic years to an employer, all in exchange for the promise of free time when you are much older. When you look closely at this arrangement, you realize the primary currency you are trading away isn't actually money. You are trading away your finite, irreplaceable time. In the 1990s, a counterculture philosophy emerged that looked at this 40-year work requirement and decided it was entirely optional. It is called the FIRE movement, which stands for Financial Independence, Retire Early. The mechanics of this approach are very straightforward. Instead of saving just enough to scrape by in old age, you build a self-sustaining engine where your investment income covers your living expenses indefinitely. To build this engine quickly, people pursuing FIRE often save between 40 and 70% of their total income. They do this by cutting any spending that doesn't bring them genuine joy and redirecting all of those dollars into investments. This requires a total shift in how you view your paycheck. Every dollar you choose not to spend on unnecessary consumption becomes a literal piece of your future bought back from the mandatory workforce. To make this work, you need a clear finish line. You reach financial independence the exact moment your investments generate more money each year than you need to live on. To find that line, we use something called the 4% rule, based on research from the Trinity study. It shows that if you have a properly invested portfolio, you can withdraw 4% of its total value every single year to pay for your life, and the underlying investments should continue growing enough to replenish what you took out. Because 4% fits into 100 exactly 25 times, you can easily calculate your own personal finish line. By multiplying your annual living expenses by 25, you find the exact portfolio size you need. If you spend $60,000 a year, your target is $1.5 million. Having this precise number changes how you plan your life. Retirement stops being a vague milestone tied to your 65th birthday and becomes a mathematical target you can hit at any age. Once you know your target number, the speed at which you reach it depends almost entirely on one factor: your savings rate. This chart shows exactly how many years you have to work based on the percentage of your income you save. If you start from zero and save the standard 10%, you will be working for about 46 years. But if you can manage to save 50% of your income, your working years drop to just 17. By making the leap from a typical 10% savings rate to a 50% savings rate, an average earner skips 29 years of mandatory labor. Every dollar saved through intentional frugality acts as a down payment on your future autonomy, allowing you to buy back years of your life that would otherwise belong to an employer. Of course, simply holding cash in a bank won't get you there. You have to invest it. The preferred strategy relies on buying low-cost total market index funds. Instead of trying to pick individual winning stocks, you buy tiny slices of thousands of companies all at once, allowing your wealth to grow steadily with the broader economy. You then shelter those investments inside special retirement accounts, like 401ks and Roth IRAs. Keeping taxes from dragging down your returns ensures your money compounds as quickly as possible. There is no single way to do this. Minimalists often pursue lean FIRE, aiming to live comfortably on less than $40,000 a year in a low-cost area. On the other end, high earners might aim for fat FIRE, building a massive portfolio to support a six-figure lifestyle. There is even a middle ground called coast FIRE. This involves investing heavily in your 20s and then stopping your contributions entirely. You switch to a lower-stress, part-time job to cover your daily bills, while your early investments grow on their own until you eventually retire. Financial independence is a customizable toolkit. You adjust the dials on your savings and your spending to build a path that fits your specific income. Exiting the workforce decades early does come with serious practical hurdles. In the United States, the single biggest obstacle is the high cost of medical care once you no longer have an employer heavily subsidizing your health insurance. There is also the danger of bad timing in the stock market. This reveals the real intent of the movement. Financial independence grants you the autonomy to choose your own challenges, shifting the focus from simply escaping a job to actively building a life of purpose. Every time you choose to add a percentage point to your savings rate, you are reclaiming another fraction of your future. You are proving that retirement is a mathematical equation, not an age.